day everyone, my name is Alessandra, blessed from BSc 3B, and today I will be reporting Chapter 11 entitled Internationalization of Financial Markets. Before anything else, let's have a recap of important terms used in this lesson. What are financial markets? Financial markets are defined as a vast global network of individuals and financial institutions that may be lenders, borrowers, or owners of public companies worldwide. What is internationalization? From the root word international, it is the process of tailoring a product, service, or operational offering for entry and growth into international markets. So how does the internationalization of financial markets affect businesses? Here are the following subjects that we will be discussing in this chapter. First, we have the introduction of global financial markets. Next is the financial markets around the world, cross-border financing, factors affecting the long-run trends of increased financial market activity, categories of investors, types of institutional investors, and lastly, the international credit markets. The flow of money around the world is essential for business to operate and grow. Stock markets are places where individual as well as institutional investors can trade currencies, invest in companies, and arrange loans. Without the global financial markets, governments would not be able to borrow money, companies would not have access to the capital they need to expand, and investors and individuals would be unable to buy and sell foreign currencies. The growing internationalization of financial markets has been the result of both large increases in pool of savings in foreign countries such as Japan and the deregulation of financial markets, which has enabled them to expand their activities. So there are different financial markets around the world. First is the New York Stock Exchange in New York, US. The New York Stock Exchange is the largest in the world, followed by the National Association of Securities Dealers Automated Quotations, which is also based in New York. The New York Stock Exchange was founded in 1972 through the Bretton Woods Agreement and initially named New York Stock and Exchange Board. Second is the Toronto Stock Exchange in Toronto, Canada. The Toronto Stock Exchange in Canada is run by the TMX Group. It was founded in 1852. It is the 9th largest stock exchange in the world and the 3rd largest stock exchange in North America by market capitalization. Third is the Japan Exchange Group in Tokyo, Japan. The Japan Exchange Group, based in Tokyo, is the largest exchange in Asia with $3.73 trillion. Fourth is from China. China has 3 stock exchanges, the Shanghai Stock Exchange, Shenzhen Stock Exchange, and the Stock Exchange of Hong Kong. Fifth is the London Stock Exchange in London, UK. The London Stock Exchange is Europe's largest with $2.68 trillion. Sixth is the Deutsche Börse in Frankfurt, Germany. Deutsche Börse is based in Frankfurt with $1.25 trillion. Lastly, we have the Euronext from the European Union. Euronext has headquarters in Amsterdam, Brussels, Lisbon, London, and Paris. Moving on, we have here the cross-border measure. Another way of measuring the growth of finance is to examine the value of cross-border financing. Cross-border finance is by no means new, and at various times in the past, it has been quite large relative to the size of the world economy. So cross-border financing, also known as import and export financing, refers to any financing arrangement that occurs outside a country's borders. It helps businesses participate in international trade by providing a source of funding that enables them to compete globally and conduct business beyond the domestic borders. Factors affecting the long-run trends of increased financial market activity. Lower inflation. Inflation rates around have fallen markedly since the 1990s. Inflation erodes the value of financial assets and increases the value of physical assets, such as houses and machines, which will cost far more to replace than they are worth today. Inflation is the rate of increase in prices over a given period of time. When inflation is low, it means there is a high purchasing power to all goods. people are more inclined to spend, and in return, producers produce more products to cater their demand. Pensions. A significant change in pension policies occurred in many countries starting in the 1990s. Changes in demography and working patterns have made pay-as-you-go schemes increasingly costly to support, as there are fewer young workers relative to the number of pensioners. A pension is a regular payment made during a person's retirement from an investment fund to which that person or their employer has contributed during their working life. These investments, usually termed as securities, is another financial market activity. Although these personal investment accounts have to some extent supplanted firms' private pension plans, they have also led to a huge increase in financial assets in countries where private pension schemes were previously uncommon. Next is the stock and bond market performance. Many countries' stock and bond markets performed well during most of the 1990s and in the period before 2008, with the global bond market boom continuing until interest rates began to rise in 2013. The appreciation in the value of their financial assets gives investors the collateral to borrow additional money, which can then be invested. When stock and bond portfolios generate income to investors, capital is secured since it produces a steady income. It allows investors to invest more, thereby increasing in return. Risk management. Innovation has generated many new financial products such as derivatives and asset-backed securities whose basic purpose is to redistribute risk. This led to enormous growth in the use of financial markets for risk management purposes. Risk management is the forecasting and evaluation of financial risks, together with the identification of procedures to avoid or minimize their impact. In this way, it helps avoid the company to risks that may cause for its recession or bankruptcy. Lastly, we have the investors. This has two distinct components, yield and capital gains. Yield is the income the investor receives while owning an investment, while capital gains are increases in the value of the investment itself and are often not available to the owner until the investment is sold. Investors' preferences vary as to which type of return they prefer, and these preferences in turn will affect their investment decisions. Some financial market products are deliberately designed to offer only capital gains and no yield, or vice versa, to satisfy these preferences. There are two categories of investors, namely individuals and institutional investors. Individuals own a small proportion of financial assets. Most households in the wealthier countries own some financial assets, often in the form of retirement savings or of shares in the employer of a household member. Most such holdings, however, are quite small, and their composition varies greatly from one country to another. Institutional investors. Insurance companies and other institutional investors, including high-frequency traders, are responsible for most of the trading in financial markets. The assets of institutional investors based in 34 member countries of the OECD totaled approximately $120 trillion in 2018. The size of institutional investors varies greatly from country to country, depending on the development of collective investment vehicles. Investment practices vary considerably as well. To put simply, individual investors are individuals investing on their own behalf and are also called retail investors, while institutional investors are large firms that invest money on behalf of others, and the group includes large organizations with professional analysts. So now we have here the 5 types of institutional investors. First are the mutual funds. The fastest growing institutional investors are investment companies, which combine the investments of a number of individuals with the aim of achieving particular financial goals in an efficient way. Mutual funds is a company that pools money from many investors and invests the money in securities such as stocks, bonds, and short-term debt. Investors buy shares in mutual funds. Each share represents an investor's part of ownership in the fund and the income it generates. Second are hedge funds. Hedge funds can accept investment from only a small number of wealthy individuals or big institutions. In return, it is freed from most types of regulation meant to protect consumers. It is a limited partnership of private investors whose money is managed by fund managers who invest in risky or non-traditional assets. Third are insurance companies, the most important type of institution investor, owning 1/3 of all the financial assets owned by institutions. In the past, most of these holdings were needed to back life insurance policies. These are financial intermediaries which offer direct insurance or reinsurance services, providing financial protection from possible hazards in the future. Pension funds. Pension funds aggregate the retirement savings of a large number of workers. Typically, pension funds are sponsored by an employer, a group of employers, or a labor union. Algorithmic traders. Algorithmic traders, also known as high-frequency trading, has expanded dramatically in recent years as a result of increased computing power and the availability of low-cost, high-speed communications. Example of this is investing in cryptocurrency. We are down to the last topic of this chapter, the international credit market. Credit market is a vital finance sector where businesses and governments raise funds by selling debt instruments to investors. There are three major types of international credit market. First is Euro credits. Euro credits are the market for floating rate bank loans whose rates are tied to LIBOR, which stands for London Interbank Offer Rate, the interest rate offered by the largest and strongest banks on large deposits. It is usually issued for a fixed term with no early repayment. An example of Euro credit is a Euro-dollar deposit, which is a US dollar deposited in a bank outside the United States. Next is the Eurobond market, an international bond underwritten by an international syndicate of banks and sold to investors in countries other than the one in whose money unit the bond is denominated. For example, a US dollar-denominated Euro bonds are not sold in the United States. These bonds are usually issued in the bearer form, which means that the investor's identity is not registered and thus is not known. Interest is claimed through a coupon which is presented for payment at one of the designated payer banks. Lastly is the foreign bond market. These are international bonds issued in the country in whose currency the bond is denominated, and they are underwritten by an investment bank in the country. The borrower may be located in a different country. To put simply, foreign bond market includes the bonds that are sold in a country using that country's currency but issued by a non-domestic borrower. For example, a US company that does business in Canada might issue a bond in Canada that is valued in Canadian dollars. So internationalization of financial markets help business owners have the opportunity to extend their business activities to other countries. In this way, it creates opportunities that could lead to financial security of a country. And that concludes our report about internationalization of financial markets. Thank you for listening.